The Federal Reserve, the world's bank. John stands in the center of the city, looking up at a massive, windowless structure of granite and steel. In the advanced, neon-lit landscape of his world, this building is the black box. He has learned how his local bank takes his deposits and multiplies them through fractional reserve banking. But he now realizes that this system is incredibly delicate. If everyone panicked at once, the banks would collapse. If the banks create too much money, prices for his keyboard parts will skyrocket. If they create too little, no one will have the cash to buy his products. John wonders, who is the architect of this system? Who watches the watchers? The answer lies inside this building. This is the central bank, known in the United States as the Federal Reserve, or simply the Federal. To understand the Fed, John must look at it through the lens of Gregory Mankiw's Principles of Economics. The Federal Reserve was established in 1913 after a series of bank failures convinced the public that the United States needed a central authority to ensure the health of the nation's banking system. It is not a typical bank where John can walk in and open a checking account. Instead, it is a bank for banks. It is the institution designed to oversee the banking system and regulate the quantity of money in the economy. It is the operating system upon which John's neo-finance empire runs. The structure of the Fed is a unique blend of public and private power. At the top is the Board of Governors, based in Washington, D.C. These 7 members are appointed by the President and confirmed by the Senate to long, 14-year terms. This long tenure is crucial. It is designed to give the governors independence from short-term political pressures. John realizes that if politicians control the money supply, they might be tempted to print money to win elections, leading to economic disaster. The Fed's independence ensures that decisions are made based on long-term economic stability rather than political popularity. Among these 7, the most powerful is the chair, often described as the second most powerful person in the country, whose words can move global markets with a single sentence. But the Fed is not just a central board. It consists of 12 regional Federal Reserve banks located in major cities across the country. These regional banks provide the Fed with a ground-level view of the economy. They monitor local bank health and provide services like clearing checks. For John, the most important group within this structure is the Federal Open Market Committee, or FOMC. The FOMC meets every 6 weeks to discuss the state of the economy and, most importantly, to decide on monetary policy. This committee is made up of the 7 governors and 5 of the 12 regional bank presidents. They're the ones who decide whether to expand or contract the money supply, effectively setting the economic weather that John's business must survive. The Fed has 2 primary jobs that John must understand. The first is to regulate banks and ensure the health of the banking system. This is a massive task. The Fed monitors each bank's financial condition and facilitates bank transactions by clearing checks. It also acts as a lender of last resort. This is a concept that gives John immense peace of mind. If his local bank faces a sudden run, where too many people try to withdraw their money at once, and the bank finds itself short of cash, the Fed can step in and lend the bank the necessary funds. This prevents a localized panic from turning into a nationwide financial collapse. The Fed is the ultimate insurance policy for the banking system. The second, and perhaps more complex, job of the Fed is to control the money supply. The money supply is the quantity of money available in the economy. Decisions by policymakers concerning the money supply constitute monetary policy. When the FOMC meets, they are essentially looking at a giant dashboard of the economy. If they see that the economy is sluggish and John's keyboards aren't selling because people don't have enough cash, they might decide to increase the money supply. Conversely, if the economy is overheating and prices are rising too fast, they might decide to shrink the money supply to cool things down. John begins to see the Fed as the ultimate balancing act. If the Fed does its job well, the value of the dollar remains stable, the banking system stays secure, and the economy grows at a steady pace. If the Fed makes a mistake, the consequences are felt by everyone, from the largest multinational corporations to a small keyboard manufacturer like John. He realizes that as a financial manager, he cannot just look at his own books. He must also look at the signals coming from the federal. When the FOMC releases a statement, John listens carefully. He is no longer just a participant in the market. He is a student of the forces that govern it. He understands that the black box of the Federal Reserve is what keeps the neon lights of neo-finance burning bright. And his next step is to learn exactly how they pull the levers of the money supply to make it happen.